All right, hello everybody. This is Emerson. I'm gonna be talking about a couple topics in this video. It's gonna be trying to keep it short. We're gonna be talking about BISI and SIBI, trying to answer Anthony's question on how and why ICT talks about it and what I have learned from it. In addition to that, I'm also gonna cover a little bit of supply and demand and how I chart and how I used to chart them. I haven't traded them for the last 4 months, but I still have the mechanics. I used to take a lot of notes on it, and I have done a lot of back testing. So let me start with SIBIs and BISIs. So the meaning, the abbreviation is BISI for buy side, sell side inefficiency, meaning when the market goes up higher, it leaves fair value gaps, such as this one, because the market moved essentially too aggressively and left pockets of uneven spaces, right? The market, because it's all an algorithm, it's going to retrace back into areas of fair value. Okay, so the reason why we call them BISI in buy side, sell side inefficiency was because it was able to deliver to the upside, but it was not able to deliver to the downside. What is it called? Efficiently. So when I say efficiently, meaning that the sellers were not able to fill in the, like, not void, but this gap, or like fair value gap. Same thing happens on the downside, which they call SIBI, which is sell side, buy side inefficiency, the opposite of what we literally said here. So that would look something like this. We have this aggressive candle, bearish candle right here. Let me change the color. It's confusing. You have this aggressive candle that moved and closed below and left this fair value gap here. So when the algorithm reprices back into here, this zone, it's gonna most likely reject. But that also has to do a lot with the context, because there's many fair value gaps that form throughout the whole charts. But it really depends on what time frame are you watching. Is it a daily, 4 hour, 3 hour, 2 hour, 1 hour, 5 minutes, and 1 minute? Because the shorter the time frame, the less importance it might have, and less respect it will have to us in comparison to a daily, because to form a daily candle is not as easy. So hopefully, can you guys still hear me? Yes. Okay. I thought my AirPods just stopped working. Okay. So like I said, shit, I lost my thought here. Okay. So yes. So the market moves aggressively and left this fair value gap, which the algorithm will reprice here as it deems as fair value. So the analogy ICT explains, and it has helped me a lot, is the paint roller idea. So I have a picture here. What did I do with it? Yeah, let me get it out here. So the analogy ICT talks about is the paint roller. So if you guys ever have painted anything on your canvas, a wall, whatever, what happens is that when you move the roller, let's say you get paint, right? Paint is the order, right? So when you move up the roller from bottom to top or top to bottom, you end up leaving like these spots. You see how there's spotty sections? So when we leave fair value gaps, what happens is it's deemed as fair value because it hasn't been fully covered. If we compare this side, which has been probably covered multiple times, the guy or girl who painted this wall probably went down and up a couple times, maybe twice or 3 times, in order to avoid having spotty action, like sections like this. So how ICT explains it, it's very similar that happens in the markets. So the markets efficiently moved upwards, but we're not able to deliver efficiently to the downside. Because remember, in the market, there's no more, there's the same amount of buyers and sellers. It's just digression. So there cannot be 10 buyers and 5 sellers. It has to be 5 buyers and 5 sellers. So what happens is that the buyers were much stronger. Therefore, there was an efficiency here and left price untouched, or in this example, like, was spotty. So when the algorithm comes back, it's gonna remember this area as, oh, it has not been fully covered. So that's why ICT's buy side and SIBIs are very critical, and they end up working pretty good. If you know which ones to follow, is because using the analogy, the algorithm will reprice back into these zones because it hasn't fully been covered. So the algorithm does not like to leave the markets inefficiently. So if the market moves up, it wants to retrace back lower and cover every single spot before moving higher. So if the market is shoots up straight up, it leaves a lot of fair value gaps here, because it was only able to deliver to the upside, like on the buy side. So meaning buyers were, yes, they were able to buy, but they're more aggressive than sellers, and sellers were not really able to fill the orders on the downside. Therefore, it's inefficient. As you can see, when we have choppy price action like we've been having for the last um, since April 23rd, this whole choppy action is because the market it needs to pick up a direction. But when we leave this whole zone, there's no real reason why we need to come back in here, as it has already done many multiple passes. I think I'm going back to the analogy of the roller. It has done multiple passes, so there's no need for it to, let's say it goes up higher, it's not gonna shoot back down, because it has, this whole section has already been fully covered. Like think about like the paint. This has been fully painted, so there's no need for it to come back. Okay. So now with that in context, there's some scenarios as here. Like I'll show you. I'm gonna dive into this one a little more precise. I'm gonna show you why there's some BISIs that you don't even have to worry about going below the low of the candle for the BISI where the candle was formed. So BISI is usually formed. Let me get the okay. So how this is and how ICT explained it is, we want to find spots in the market where it is aggressively moved up. It can be in any time frame. The greater time frame, the better. Okay, so we have this daily here where we had a basing period from the 23rd of March and then aggressively shot up. Okay, this is a coffee bar or up a bullish candle, whatever you guys want to call it. But we have energetic movement. So remember, we retailers don't not move the market. It's all institutional flow. So if we try to follow why did this happen, is because think about a big whale came in and like scooped up the market. They took the market higher. Maybe they were accumulating along this whole area, and then they decided that they were ready to take this market higher. Therefore, because this bullish candle, okay, perfect. You left this fair value gap. So now when the algorithm reprices back into the zone and we're still in a bullish trend, we can expect this zone to be respected. Just because we are in an upward trend, this is deemed as a fair value under the eyes of institutions. Okay, and sometimes we have many fair value gaps. You can see we have one here, we have one in the middle, then we have one more all the way on the top. Some fair value gaps will not get respected. As you can see, this one got respected initially. We had a little rally, but then when we went the second time around, we essentially blew through it. Okay, and that's fine. What happens is that how I see it, I try to link it up a little with supply and demand. I see this aggressive moves as, okay, the market moved aggressively, so the orders that were still here are no, either they have been already picked up by the sell side, so efficiently covered. So if the market moved higher and then the market won't move lower, essentially there's no really no more defense, we can say. Here, going back to an analogy, this body action is unsettled orders that have not really been settled. Okay, so if the market moves efficiently to upside, then there's spotty sections here. While here, I wouldn't really consider this anymore. As you can see, we kind of blew through most of it. So next time, the second time around that we happened to touch it, it just didn't respect it. But there's a lot of caveats to that. So the main premise is that buy sides are seen to form when the market moves aggressively to one side and it's not able to efficiently deliver to the downside. So just using the analogy of the roller, the paint roller, it painted on the upside, but it quite didn't fully paint the downside. Or if it's easier for you guys to understand, think about like when if you guys have ever cut grass. When you're cutting grass, you go one way up and then you. Let me see if I can find it. Okay, yeah. So whenever you guys are not this, when you guys are ever cutting grass, as you notice, we have this very nice clean patch of grass, but then you have to come back and essentially touch up this whole line. You have to kind of cover a portion of this section, because if not, you're gonna have like a weird line in the center, like within this patch and the other patch, even though they might be the same, but if you don't cover slightly through this section, it's gonna be weird. So that's where ICT talks about how we have mohawks, and the market tends to respect the zone, but it's not gonna just touch into shit. it's not gonna just touch the beginning of the box and just bounce. It wants to go a little inside of it, or sometimes we'll just respect the 50%, or sometimes we'll go all the way. And so that's the main premise of why it's important. Let me see if I can touch on cities because I want to still touch on supply and demand, and I'm taking a little too long than I anticipated. Let me go on a 4 hour. Okay, cool. So here, this is a prime example of what ICT talks about the roller analogy. Okay, so here, the market essentially left cities, right? So colors red. So this whole section, meaning the market moved aggressively to the downside, and we left this fair value gap as which is being as fair city. Sell side, buy side inefficiency. It was efficiently delivered to the sell side, but it was inefficiently delivered to the buy side because the market was not able to retrace back into itself. So when the market does, it's a great opportunity for shorts. Okay, but what happens when we go above it? So this is going back to the same mohawk and paint roller analogy. The market already essentially did two passes through this whole wall. So the market does not need to go again through this whole section. So if we extend this whole section around, the market does not need to come back down to the section. It does not need to pass around this whole section. Why? Because it was efficiently delivered to the downside, and then it was efficiently delivered to the upside. So therefore, you have two passes. You only need two passes. Anything more than that, it's just overdoing it. So now we could use that in context, and we can look for long opportunities here after we realize that okay, we had a SIBI, but then at the same time we also formed. If you guys have been paying attention, you can notice that we have also a BISI, meaning a buy side and sell side inefficiency right here. So why did it not? Why should you not worry about the market going lower? Like let's say you decided to actually use this area as a long opportunity to target this buy side liquidity up to highs, was because we already delivered to the downside. There's no real reason for the market to go lower. Some scenarios the market will retrace back lower. It can be due to events, news, whatever. But usually the market wants to be efficiently delivered to upside and downside. That's why SIBIs and buy sides and efficiency are very, very critical. I believe that's going to be it for that and the analogy behind it. It's just very simple. I try not to overcomplicate it. Just remember the market wants to be as efficient as possible. It doesn't want to leave any mohawks or like unpainted areas. So when the market moves aggressively to the upside, it will retrace back lower just because this whole section was delivered inefficiently. Okay, just to keep that in context. It might take a year, it might take 2 months, it might take 5 years, whatever it is. But the algorithm will always refer to that unless there's like a black swan event that the market moved up aggressively, and then let's say all this whole fair value gap that we left here, the market aggressively started going lower. If there's a black swan, it's not gonna respect. This is gonna go. It might have a little period of pause, but it's not gonna respect it because the sentiment has changed. But that's on a whole different topic. But the concept is pretty simple. Okay. And in addition to that, I'm gonna talk a little bit about supply and demand. So let me actually. Hopefully, I was clear on how the BISI and SIBI. If you guys have any questions, shoot me a text. But let me talk about supply and demand. So supply and demand, how I learned it was something very similar to BISIs and SIBIs. Is the only thing is that we find areas where the market was unbalanced and where the market had equilibrium. Okay, so how I learned it is through this guy named Carmine Rosado. He's Wall Street. He has a cousin, uncle in Wall Street, and a lot of his family have worked in Wall Street. Blah blah blah. But the main reason what he explained, this was like I learned it 2 years ago, but I've been implementing it for like the last year and a half. It's really good strategy. I'm not gonna say it isn't. It's just I happened to stumble across ICT and I really like the method. But how I tend to use, I used to use supply and demand was we would want to find areas where the market, let me get the highlighter, where the market move efficiently, like move aggressively to upside and then start consolidating. Okay, this whole consolidation, which is what we're looking for as a potential supply or demand zone. This whole like area. Okay, and when the market breaks out with momentum, we will deem this box. Let me change the color. We'll call it red. This whole green box, I would deem it as demand zone because we had essentially a lot of accumulation during this whole phase. And as you know, we at retail don't move the market. So this move upwards was not caused because retail decided to buy. It was because big hedge funds or whales decided to move the market. So if we use that footprint, we can expect that when the market goes lower, because whoever, who the only one that accumulated longs here was the big institution hedge funds. Okay, so if hedge funds accumulated positions here, it's expected that when the market goes lower or retraces back into the zone, that they may be respected because they essentially initiated their position here. Think about um like this. So let's say you're a hedge fund and you buy stock at 10, right? You have $10 million of stock X1Z. You want your target to reach 20. Okay. Okay. The market starts. Let me change color so it's not confusing for you guys. Let me actually remove this. Okay. So let's say you're a hedge fund, right? You bought $10 million of stock at X $10, right? You're expecting the market to slowly but surely reach your point of 20. That's your area of selling pressure, right? But let's say hypothetically the price only reaches 15, okay? $15. Okay. You are able to scale out some portion of $15. Let's say hypothetically you had a sell position here, you sold some or you didn't sell some. Now you still have your position at $10, right? So let me make this like a box. This is the area where you buy. Let's say you buy from between 10 and $9 and $10. Okay, so when the market essentially retraces back into its own, because even hedge funds do not fully have control over the market. There's so many moving factors. So when the market actually goes back lower, they're gonna try to defend their position because they're not gonna let $10 million just go to waste. So let's say they were expecting to make, this is a 2 to 1, so they're expecting to make $20 million by selling at 20. They're not gonna, either they're gonna fight for their position or they're gonna essentially stop off for a loss. But that's usually does not happen because they have leverage. They have the money to back up their place. So if they really wanted to reach $20, they're gonna do so. So if the market retraces back into the entry point, they're gonna essentially add more. So this is why supply and demand ends up working really well, because these zones are critical. Similar like BISI and SIBIs, they're like areas where the hedge funds have deemed as a reasonable area to go long. A reason they have showcased strength, because the market is not, they not just move on fluff, they just don't move on like fake money. It's actual physical money that makes the market move. Okay, so if money was the one that backed up this initial move, wouldn't you expect when market retraces back into here and then they haven't fully reached their objective? We don't know what is their objective, but essentially, if the market, let's say, was moved up $1 or two and it was not as aggressive, we can expect this demand zone to hold. Okay, but there's a lot of things that go into what is a good supply and demand zone and what is a bad supply and demand zone, because there's many. Like, you can deem this demand zone as high quality, and then while you can deem this box here as low quality demand zone. So let me remove everything here. Let me talk a little bit of what I have learned, what is high quality and what is not. Okay. So how I have learned what is high quality and what is low quality demand zones is by seeing the energetic move that was that was followed after the demand zone was formed. So hypothetically, let's say here on March 28th, we had this basing period. So a basing period can be a red day, a doji, whatever you guys can call it. So how I learned how to draw boxes with supply and demand is we want to see a red basing and then a nice strong move higher. So the stronger move, the higher likelihood of this demand being strong. Okay, because going back to analogy, if Wells or like big hedge fund managers want to move the price higher, and if they do it aggressively, they know they have a lot of money behind that move. While in comparison, if you go to, like, let's say, let me try to find a weaker. Let's see. Okay, here. So we have this demand zone here too. Okay, so this essentially, this black box here could also be considered a demand zone. And how I usually used to draw them is I would use the prior candle, which will be a down close candle, and then I will use the upcoming the following candle. It could be red. It usually has to be green, right? It has to be there's a red basin and a strong rally upwards. But as you can see from the basin is into the high of like the most recent upswing was only around 160 points. Okay, but if you notice, we're still within this bigger leg, downward leg from February 2nd all the way to March 2nd, a whole month, we were down 279 points. So you only retrace, this is just a small retracement because the higher leg, like the bigger price move happened from February 2nd down to March 2nd. Okay, so yes, we had a nice bounce, but the main reason why this box was not really super supportive. Yes, we broke below it. When I draw my supply and demand, I want to see them being well respected. I don't want to see them like break down and go back above them, and I wouldn't like to trade that. I want to see respect this within the box. Actually, like something similar. I'll find a nice area. Um, I want to see respected areas that they don't validate and those don't blow through them. Okay, everybody looks at supply and demand differently, so there's no one shoe fits all. It's really what you have seen and what have you like analyzed and backtested. Personally, I like to see more. Not if this demand zone gets invalidated, either if I see new demand being formed, like I start seeing like a doji candle and then an uptrend move, then I might be like, okay, cool. This demand is no longer valid for me. Let's see if we can start going to a smaller time frame. Maybe going to a 4 hour. I wouldn't be surprised if we have some supply that got formed on the lower time. As you can see, we could essentially use um, green candles on green candles. I just don't. I like to see basing candles, meaning red candles, or like those like oscillation period before we move up. So that really comes down against to what is your preference. I just noticed that the best and the strongest candles are down close moves for bullish momentums. If you want to find demand, down close moves, follow with a nice strong rally. As you can see here, we have this doji candle before. You know how ICT talks about order blocks? This whole thing is called the order block. So this whole leg from here all the way to low would be an order block for him, right? For me, if you're talking only specifically supply and demand, I would only consider the last candle before the move upwards. As you can see here, we had this doji candle, sort of a down close move, and then we had a nice move that was around 84 points. And this move was drastic in comparison to this whole choppy action here. So yes, this 84 point move is less than the initial from here to here 114, but you got to use it in context. You just can't be like, oh, this demand is better, this one is worse because of that. So really, it's very, you have to kind of like use it to your own judgment, like seeing what was the movement that we got off of this specific demand. And as you can see, we moved higher, retraced, and then there is yes, we went inside the demand, but we respected it. We didn't really break below it. Therefore, this is now deemed as a nice demand zone. The only thing with demand and supply zones, because how it works is that institutions have, let's say, $10 million of funds and they want to buy $10 million at 139, right? Let's say this is their whole zone, 139, 90, 39.21 and 38.95, like 15-20 point range. This is their whole range. They want to buy $10 million of stock, right, or futures or whatever they want to buy. It doesn't matter. What happens is that when the market retraces, let's say here the market they were only able to fill in five 5 million, right? Just because they're so big. And usually when they put in orders, they usually try to do block orders. So they put in half a million, quarter of a million, 10,000, 50,000, 100,000 orders at a time. Therefore, it's not going to move the market. But whenever they place a big block of orders, it's going to cause this drastic moves upwards or downwards. It doesn't matter, So they were unable to get their full $10 million position on. So what happens is that they only got 5 million. There's still $5 million sitting here. That orders have not really been filled. This varies a lot because with all this what is it called spooling and stuff that people put in orders and take them out, it's kind of hard to gauge what it is. But with supply and demand, usually orders that have proven strength, like as you can see, this candle here on the upside has proven that there is actual money behind it. We can expect. It's a probability game. We can expect that orders are still going to be sitting here. Not 100% because like let's say there's a black swan event when the market retraces back lower, the hedge funds are gonna essentially remove their orders, But usually, if there's no events that are super high importance, they're not gonna really move the orders because they want to get filled at the desired prices. Because many of them have to move money. They have to manage billions and billions of dollars for clients, agencies, etc. So their goal was $10 million and sell at the highs, let's say, and they only got 5 million. They're 5 million short. So their plan is no longer is still valid, but they would want to ideally get their whole full position on. And this can really like it's really up to your analogy. Like some people don't believe in that. Like I know ICT doesn't, and he says like the algorithm. So there's just different ways to see the market. This is how I learned it. Uh, it's important. It's good. It's really just using it in context. Like seeing okay, what is the daily time frame doing? Okay, what did we do? Did we move aggressively to the upside? Let me see. Move on a weekly time frame. Yeah, like here. Okay. So hypothetically, we could say, okay. So you know how the market has been gyrating back and forth, back and forth. Okay, from this low, why this low important is because we have this down close candle before an upward move. This move is pretty significant as it went from 38.79 all the way as high as 4,200. That's almost a what 200, 300 point move. And 1, 2, 3, 4, 5, 6. Like in a month, okay? In a month, it went up 300, 350 points. Okay, that was significant. Look what happens. The market retraces back into this quote unquote the demand zone that we deemed as demand zone. And we respected it. Not every single demand will be respected because it really comes down to context. But if you can find areas that you potentially could go long or short, it's just an extra um, confirmation. Like let's say you have a BISI within this area, or you have buy side, sell side liquidity that got just taken out. In addition to that, you have demand zone. Then you have a super charged trade. In my opinion, that's how I would consider it. Let me see. And essentially for supply is going to be the same exact thing, just inverted. I don't want to even cover it because I already probably did this video for like almost a half an hour. I was only trying to do like 15 minutes, but as you can see, there's a lot of moving parts and a lot of moving pieces that one needs to really take into consideration when looking at supply and demand zone. Which also the same thing with BISIs, and we look very similar. If you look at my chart and you look at boxes, green boxes and red boxes, you might be like, oh, they're both the same thing. When they're not. One is busy, this is inefficiencies, and then this one is essentially unfilled orders. Unfilled orders that markets were not able to fully complete their position. Therefore, when it retraces back into it, we can expect like a barrier of orders still sitting here. Because limit like big institutions when they place out a limit order, they're not really gonna be moving it in and out, in and out. They're gonna be leaving it because they're a big well. They're not. They don't have. They don't want to be like. How can I explain? They're not like we as traders that we can cancel orders because it's only one lot, two lot. They have millions and millions of lots, you know, at a time. So that's why they just leave the order there because they have conviction. And if the market starts going against them, they're gonna fight for this position. That's why it's kind of iffy that because ICT talks about how there it doesn't matter how much um, buying and selling pressure there is, but supply and demand is kind of based on that. Like okay, if you start going lower, hedge funds might fight for it, but at the same time, it really depends on the algorithm. It might be that the hedge funds have control of the algorithm by putting more orders in there. So it's just iffy. So that's why it's kind of confusing if you try to trade with both of them. But nonetheless, it's great to just know. You know. Let me see if I can. You can find essentially demand zones in any time frame. Just the lower time frame, the less I wouldn't say quality, but less strength. So 4 hour demand zone is going to be much stronger than a 30-minute demand zone. By no means, I'm not saying don't use a 30-minute. It's just expected. Don't expect it to have like a 1,000 point rally. In comparison to a weekly, you can expect a 300, 200, 300, 500 point rally because it was deemed as a higher time frame. And also really depends on like what was the initial move. And I going back to the on the weekly. If let's say we form a weekly demand zone from here to here, right? This move essentially this weekly amount, this consolidation before the rally, essentially moved from 29.02 all the way to 47. That's almost a 2,000 point move. That's massive. So when the market comes back into the zone, we can either expect it to respect it, or it because it's too old, it might not even be respected anymore. But usually, it will still be viable. Like it will still work. You just need to take it like a fine comb. You have to kind of analyze it and wait it out. Okay, what was the importance of this demand? Was it did it consolidate prior to this massive rally? Okay, because there's gonna be a lot of um, short term like demand zones that you might be like. Okay, for example, like here, you could essentially this black box. She's let's see, this down close box essentially could be considered a demand zone. But look what happened. The market essentially traded back into it and did not validate it. But the reason is because it didn't move a lot of points. It moved from 40.98 into 40.41.50. That's what 17 points. It's like not even significant in comparison to the higher time frame move, which is from the high to low. It moved 73 points. So this little, yes, we have a a down closing candle and we move higher, but it's not significant. It's like the same thing with BISIs. You can see BISIs and SIBIs all over the place, but you really have to use it in context. Okay, where did we see it? Is it in the upward trend? Here, it's clearly in a downward trend. So demand zones are not going to really work. That's the other thing too. It's like BISIs and SIBIs. If we're in an uptrend, BISIs are going to work best in uptrends, and then SIBIs are going to work best in downtrends. Okay, same thing. Supply zones are going to work best in downtrends, and demand zones are going to work best in uptrends. So all we want to wait for is a retracement back into the demand zone or a BISI, and then we long it or we enter accordingly to a risk. How I use BISIs is, I know I'm going for it so long, but hopefully you guys find this insightful. How I use BISIs and like one of my main like strategies that I've been using is using equilibrium. I try to keep my like analysis very simple. I want to see when the market was, let's say from here to here, right? The market moved up aggressively, as you can see here. Okay, which area will we deem as fair value, and what is discount and premium? So ICT talks about discount being below equilibrium, and then he talks about anything above the 50% being premium. So this is premium. I'm gonna highlight it red. This is red. This is premium, and then anything below the 50% is gonna be discount. Okay, so let's say we're looking for longs. Let's say you have a weekly bullish thesis, right? Let's say you're bullish. We can try to find. This is what I do. I try to find a BISI within below the 50%. This can vary. It can be the 68, the 63.8, whatever fib extensions you have. You can essentially tweak with it. There's no one size fits all. But honestly, I would find a BISI that fits in below the 50%. This could be a little pushy because it's right in the middle. You can start going into like, let's say, a 30-minute time frame, and I would try to find any imbalances that were formed here. Okay, so here you don't have any sort of imbalances, so I would probably go down to a 15-minute. Okay, cool. As you can see here, you have one here, so it's below and it's a little more precise. So I would keep my focus in this zone more. I'll put more attention in this zone because it's below the 50% and it's a smaller time frame because it's just more precise, rather than having a big box that I'm like, all right, cool, this is so much risk. Let's say this is a BISI, right? There's like if you enter at the beginning of the box and then you put your stop at the bottom, that's too much risk. So I want to go precise. And same thing you want to do with supply and demand, because sometimes there's demand within demand within demand. So you want to go as precise, but at the same time having an idea of what is the bigger time frame picture. So I'm gonna end it there. Hopefully you guys found that video insightful. If you guys have any questions, shoot me a text or send it to a group chat. Hopefully this is not super long, but I know I've been talking for almost half an hour, but hopefully you guys find this insightful and we have a wonderful day.